back to another Soulful Trade video. And today, in this video, you guys will be learning the benefits of trading stocks and investing in the stocks, and the benefits of investing in options and the bad side of investing in options. So by the end of this video, you will learn and you will know how to place your first option, call, or put. You asking me what a call or put? Stay tuned into the video. You're gonna learn how to start placing options. Nonetheless, make sure you guys hit the like button, you subscribe if you're new, and comment your favorite part of this video to keep engagement. But nonetheless, let's get into it. Stocks versus options. So this is my favorite topic right here because everybody always asking me what is stocks versus options. What is a stock? So basically a stock is you own part of a company by buying shares. You trade and buy and sell on an index or exchange, New York Stock Exchange, Dow Jones, NASDAQ. You buy shares so you can hold them for however long. And that's the good thing about stocks. You know what I'm saying? If you buy something, it's yours until forever, until you decide to sell it. You know what I'm saying? It's not like if you have a part of shares, you have to get rid of it by the end of the year. And some people use this to beat taxes. They have own shares of stocks and they don't have to pay so much on taxes because they're still holding the stocks since like 2008, you know, 20 years ago. You know what I'm saying? That's why they don't have to pay as much taxes. So that's the good thing about stocks. And you can buy partial shares nowadays. Like back then you had to buy the whole share of a stock. Now if you had $10, $15 and Apple stock costs $180, you can put $10 in to Apple and own partial shares of the company. How to profit from a stock. You can buy low and sell high. And number two, you can buy high and sell it higher. Steady growth in stocks is why people invest in stocks, because it's a steady way to build your wealth. It's less risky in amount of capital you have. How to calculate your profits. So risk reward. You want to think about risk reward whenever it comes to calculating your profits. So you have the number of shares that you buy, you multiply it times the difference between where you buy in the market price and where you sold in the market price, and that will equal the amount of the gain and the loss. If you profit or you lost, it'll tell you it depends on where you bought and where you sold and the amount of shares that you have. So for example, if I have 10 shares of Apple and I buy it at $180, Apple next week goes to $200. So 200 minus 180 is $20, and I have 10 shares of that. 20 times 10 will be $200. Stock terminology. So what you need to know for terminology about stocks is the long and short, bullish and bearish, risk reward, buy and hold, and back testing. So if someone says they're going long, they expect price to rise. They expect further price movements to be higher than what they are right now. If someone says they're going short, then that means they're expecting prices to fall and price to drop in the future. And bullish means that someone is expecting prices to rise and they're going to be buying. There's going to be a lot of buyers. Bearish means that prices are expected to fall and a lot of people are selling. Sellers are in control. Risk to reward. Basically, risk is telling you how much you're willing to lose in the trade, and the reward is how much you're expected to make in a trade. Buy and hold basically means that you're buying and holding. This is what it is. You're just buying the stock and owning it to decide where it's comfortable for you to sell it. And there's no telling how long you can hold it. You can hold it for however long. Back testing is you using a trading strategy on past dates and past patterns and candlesticks to decide where you want to buy and profit in the new current market condition currently. So you're using past dates and past candlestick history to make a better prediction on price to make a profit. Stock benefits. You never lose until you sell. your shares. You know what I'm saying? Because one thing about stocks, Warren Buffett, the best investor, once said that he does never lose in his portfolio tremendously until he decides to sell. So that's a benefit about the stock market. You don't ever lose money until you decide to sell. So the stock could be down for 4 consistent months, but you never lost money really until you decide to sell those shares. An alternative to a savings account with fluctuating days. You know, it has good days, could be up 50% one day, and the next day you could be down 25%. So those fluctuating days is what benefits of stocks, you know, because compared to savings account, it just stays still every day. You look at your bank account, it's still the same amount of money until you get paid. It's another way you can build wealth over time and doesn't have an expiration. Indexes show that the markets rise exponentially in the 5-year time frame. So people say, what about if the stocks crash? Well, the stock market does crash, but it's always bound. History proves that it does rebound. So even though it crashes, a bear rally does happen where stocks drop tremendously in price. It's known to recover historically. Data proves it. The stocks risk. You know, as you see, I don't have as much risk on the stock side because there's not much, you know. You can experience losses in bear markets conditions and losses in portfolio with impatience or fear or sometimes greed. This is what it is. Sometimes people get too greedy and they end up buying real high or just buying because impulses to make money, and they can experience losses when they sell that stock. Sometimes they don't have to experience losses if they hold the stock. Let's get into the meat. Make sure if you staying this far to the video, you hit that like button. You comment down what you learned on that stock section. We hopping into options. Let's get it. Options. What is an option? An option is a contract given for a fixed price, cheaper than what market value is, and that comes with 100 shares, a strike price, and an expiration date. So basically when you go to the store, you get a carton of milk, right? Well, normally when you get a carton of milk, it'd be like $4, and if carton of milk comes with an expiration date, well, it'd probably be like 2 weeks ahead. So it'd probably be like right now it's February 8th. The expiration date will be February 16th. Okay, so it comes with the expiration date and the price. Well, a company, say that you have a lot of people wanting to buy milk. A company will cut you 10 cartons of milk. Instead of $4 each, they'll give it to you for $20 for 10 cartons of milk. And another thing, they'll give you the same expiration date. They'll give you an expiration date on that milk. So you're getting 10 cartons of milk for $20, and the expiration date is February 20th. So every time you have an option, it comes with a strike price. You get basically a price that's right here, that you see right here is 177 call, and then whenever that strike price comes with either a call or a put. A call is basically you're expecting the price to rise, and a put is you're expecting the price to fall. And every option comes with 100 shares. So this is way better than you just buying a stock. Because if you wanted to buy a stock for 100 shares in market value, that would be way more expensive than if you had an option. Because they give you an option for 100 shares way cheaper than what it would be for a market to buy a stock. But the thing is, these options expire at a certain date, and it will be worthless if it's not sold by then. So boom, if we look at this diagram right here, we have the strike price. Well, basically, will tell you that if the strike price will basically you'll be able to buy the option if it's in the money or out the money. So the ones on the bottom are in the money, and the ones above are out the money. And in the money or out the money is based off what the market condition is currently. So Apple is currently at 179. The stock is basically showing you that these on the bottom on the options right here, 177 is currently in the money because it's lower than where the market value is. If it's higher than what the market value is, then it'll be out the money. And then we have right here 4.23, and these numbers right here are basically the price of what these strike price options are. So if we multiply 4.23 times 100, because you get 100 shares of the company in the contract, basically 4.23 times 100 would be $423. Easy way to calculate the price of these options is add another zero at the end. So this will be 603, this one will be 808, and this one will be $1,033. So you can just add another zero at the end. There'll be a quick way to determine the price of these options. And at the top you got the call and the put. And all of this right here is an option spread that shows you the dates at the top right here. It shows you the dates of how much dates ahead of time they have for options. They got currently, the current dates are in the front and the more further out dates are ahead. So a call versus put. A call is betting that the prices will go higher and you're feeling bullish. The price of a call rises when its underlying stock goes up. If the move in the stock is too late because it happens too close to the expiration date, the call can expire worthless. So if the move does not happen in the amount of time that you expected during the contract that you get the option, you can lose your whole initial investment. So if I expect Apple to rise from 177, where I actually buy at my strike price, and Apple stays at 175 until the day of my expiration date, which is when I buy my contract, it expires next week, okay? Now next week comes, Apple is way lower than where I bought it. I will lose my initial investment, and that's it. The whole $200 I spent on the contract will be gone. A put is betting that prices will fall and feeling bearish. The price of a put rises when its underlying stock goes down. So what is the strike price? I gave y'all a brief explanation what a strike price is, but a strike price determines whether an option is in the money or out the money, and whether the option will be exercised at expiration date. So whenever you look at an option strike price, you can determine if it's in the money, out the money. Basically, if it's in the money, then it's higher than where it's lower where than the market is at current price. So if the stock at Apple is 179, in order for it to be in the money, it would have to be lower than 179. If it's out the money, then it would have to be higher than a price at 179. So it has to be at 180, and 181, and 182. So these up here will be considered out the money, and these right here in the bottom are considered in the money. That's because it's lower than what it is in the market. That's how you determine in the money, out the money. So you want to have options that are in the money. That's because in order for it to be in the money, you have to buy low and sell high to profit, right? So that's why you want to be in the money whenever you profit, especially whenever it's a call, because the lower that it is on the strike price, then the easier it is to profit when the stock goes up. Options terminology. So we got expiration, we got in the money, and we got out the money. We got strike price, we got call, a put, and back testing. See, back testing comes a lot in this video. We've seen it on the stock side, and it's going to continue to be on options. Back testing is important whenever using trading strategies to make profitability. The difference between stocks and options. Time is everything to an options trader. Time decay, time value decay. Something stocks do not have option prices changing lower percentage moves up and down. So there's drastic moves whenever you're in the options. So whether it's up or down, there's drastic moves just because you're playing with 100 shares, which is more position size than a normal stock. So in the time decay would happen if closer to expiration date, the value of the stock goes down. So it's not good to hold options for too long just because that time decay is a factor of risk whenever you're holding an option. You're not holding those 100 shares of a company forever. It comes with an expiration date. You have to get rid of it. I recommend that you get rid of the option between a day or two. Sometimes just day trading if you see a quick movement in the moment. It's not something you have to do where you have to buy and hold like stocks. Important pricing factors. Options with more time until the expiration date are more expensive. So this can be an edge for your strategy. Options with more attractive strike price are more expensive. So if you want an option strike price that's way in the money, that's lower than what the current price of the market is, then you have to spend a little bit more bread. But that can be a lenient way that you can save and avoid risk to your trading strategy, just because you're having ways to get out of risk. Basically, you have lower strike price and you have a further time ahead. So you got two ways to have an edge in the market just in case your strategy goes against you. The benefits of options. The benefit from upside moves for less money. So you can profit from stocks going up or down for less money than what it would to have a stock. Then you don't have to have a whole bunch of capital to play it with that amount of position size, 100 shares. A profit from downside moves stocks without the risk of short selling. Sometimes short selling can be very risky and end up blowing up your whole account and playing margins. Protecting an individual stock position or entire portfolio during periods of falling prices and market downturns. So you can protect the initial portfolio of holding your stocks, but if you see the market's going against you, you can have enough capital in your brokerage to short the market with options. Risk of options. Option contracts have a limited lifespan. It's not something you want to hold until the last date of when you got to sell your options, because it will be guaranteed almost worthless unless there's a drastic move that happens on the last date and it explodes. And that is possible, but it's very risky. Each contract has an expiration date, and you want to pay attention to that expiration date and make sure that your move happens before the expiration date. If the move you anticipate does not occur by the expiration date, you will lose your entire initial investment. The wrong strategy can lead to losing trades. This can be in the form of major losses in any individual position, but not necessarily to your entire portfolio if you manage your position size. So if I play with $1,000 in my account, 250 will be a good position size to put on an option. You know what I'm saying? Because I would have 5 attempts to play. If I lose, I would have 5 times to recover. Compared to a person that's playing with a position size of $1,000, he only has 1 time to recover for a major loss. So make sure you always consider your position size when playing with options. It's not all fun and games with options. Gain a comfortable feel for stocks and indexes before starting options. I recommend you learn and study stocks and have a real edge in stocks before you hop into options, so you'll lose a lot of money. Understand the relationship between the market and options related to them. Requires a rewired way of thinking and transition from stocks to options. You got to think different. You can't just think about buying and holding options, because it will be very risky that you do that, because time is against you. That time decay is eating up. Start paper trading before you feel, or start trading strategies, and avoid a heavy loss of capital. Review how a set of strategies worked in the past. Backtesting. Backtesting is your friend. Make sure you write down, you enter where initial price is and where you exit, how much shares you got. Practice that first before you hop into options. Another thing is, the other way you can get really good at options is notice how the market condition affects option prices. That will be it for this video. I hope you guys tuned in. Now you can start your options journey, and you can start your stock journey and have both ways to diversify your portfolio. If y'all like this video, make sure you like, comment, subscribe, share with your friends. We out.